Let's talk more about the auto industry specifically. Rising rates are putting affordability at risk for people who are looking at those high gas prices. They have this to contend with as well. In a recent note, our next guest said, should rates continue to rise, consumers will likely face an increase in monthly payments, of course, which could pose concerns for vehicle affordability and sales. For more on this, let's welcome in Bank of America Securities Senior Autos Analyst John Murphy, as well as Yahoo Finance's Pras Subramanian, who's here with us on set. John, thanks for being here. So you have effectively what we're seeing start to happen in the housing market, also a potential risk in the car market, right, where you are seeing financing costs go higher. But conversely, does that mean we're finally going to get a little bit more relief on the pricing front for cars?
Sure. Well, Julie, thanks so much for having me today. There's a lot of moving parts, I think, as you just alluded to, with gas prices rising as well. And I think when you look at every 100 basis point increase in auto loan rates, it's about $15 to $20 on a basis of about $600 on monthly payments. So what we've seen is about that so far in a 48-month average rate. Auto loan rates have not been as volatile as mortgage rates. So we're getting sort of an impact that is not as big. But as you look at this versus gas prices and depreciation costs, you're kind of at a push on the monthly carrying costs to the consumer when you include depreciation costs. Now that means you're selling your vehicle and you're getting the benefit of lower depreciation. So there's a lot of moving parts here. But all else equal, these rising rates and these rising gas prices are a real problem for auto demand. The caveat really to all of this is there just aren't enough vehicles on dealer lots and 1 to 3 year vehicles on the road in the United States. So we are building a lot of pent up demand, and the consumers that are buying nearly new used vehicles and new vehicles as well are fairly well-heeled, higher income consumers that will be less impacted from this. So where we're starting right now at recession level auto volumes, because supply is so constrained, we don't have a lot of concern about too much downside to demand, but it could really dent any significant recovery in the next 1 to 2 years.
Hey, John, Pras here. You guys had a lot of good information in your note about, the level at which, we've seen situations where high rates haven't actually led to decreased sales in autos. But is there a point where there is a rate that would actually destroy kind of demand for new cars or even used cars at those where rates as they are now?
Sure. It's a really great question. So if we look at, the 100 basis point rise in rates, it's about $15 to $20 a month on the monthly payment. If we've seen what's going on with gas prices, it's about each dollar increases, or actually the $2 increase is almost about $40 to $60 a month on each individual vehicle. But then when you look at depreciation cost being lower because used vehicle pricing is higher, you have about $100 good guy. So the net of these three big moving parts of rates, gas prices, and depreciation costs are not too tough for that new vehicle buyer. Once you get to sort of the second and third buyer, that's where things get, into sort of the middle and lower income consumer, and things get tough. So I think we're looking at sort of the balance of these three big swing factors right now, and the strength in used vehicle pricing is a very important and actually bigger factor, believe it or not, than what's going on with rates and gas prices. As we increase the supply of vehicles that are being produced, there's risk that depreciation will go up, cost, and we could see things really keep a lid on what we expect to be a significant recovery. So we got to watch all three of these factors, swing factors, moving at the same time. So the interest rates are actually less important, believe it or not, at the moment than gas prices and that depreciation cost.
John, we've seen a massive push by the major automakers into crossovers and trucks, but that has come against the backdrop of relatively affordable gas prices. That's no longer the case. Do you think we'll see them swing back to making passenger cars because of this environment we're in?
Well, there's a lot of different strategies in the market right now where the D3 or the traditional D3 have moved away from passenger cars, and the Japanese and Koreans have still kept a reasonably large portfolio there. So that's where the benefit would come, more on the Japanese and Korean side, if we see this kind of a move. Because we're selling so low in sort of the sales rate recession levels because we're supply constrained, the mix is going to stay very strong until we actually see supply coming back up and actually get a sort of a vehicles available for sale, right? Because they're just not there at the moment. So I do think in the recovery, you could probably look at sort of a greater mix of passenger cars and smaller crossovers. Remember, these crossovers are unibody essentially jacked up station wagons, if you will. They're not the body-on-frame gas guzzlers. They're relatively fuel efficient themselves. But you'll still see a negative mix shift as we go through the recovery. So that would benefit the Japanese and Korean companies a bit more than the D3. So that would dent industry profitability relative to the recovery in volume. So once again, we'll have to watch operating leverage versus mix, and that'll be a delicate or interesting dance when we look at profitability through the value chain.
Hey, John, on a related note, when you look at the affordably priced hybrid and electric vehicles that are out there, I mean, it doesn't seem like there would be enough to meet demand if there is indeed increased demand with higher gasoline prices, right?
Yeah, there's another, it's a very good question, Julie. There's another very difficult dance here right now with that. And when you look at the increase in nickel, cobalt, lithium prices, the cost of these electric vehicles has gone up much more dramatically than even the internal combustion engine vehicles. So unless the industry wants to eat, an incremental $1,000 of cost on an EV versus an ICE, they're not going to push the EVs as aggressively here in the near term. And if they do try to pass that cost on to the consumer then has to eat another $1,000 plus for the payment or the price of these EVs. So that switch, which if you were just to look at gas versus electricity cost, makes all the sense in the world. But when you look at the asset price coming in, it becomes a lot less clear and actually becomes a net negative for EVs versus ICE on affordability in the near term. So like I said, there's a lot of moving parts of what's going on here right now. But that raw mat swing on EV costs has been pretty extreme in the last 6 months, even more extreme than what we've seen in gas prices or steel costs going into the cost of ownership on an ICE vehicle.
Hey, John, given all those moving parts and the rising rates and things like of that nature, as well as the kind of diminished supply, in your coverage universe, what auto companies or what suppliers are really well positioned here to do well going forward in the next year or two?
When we look at, we cover the value chain, so we cover the automakers, suppliers, and dealers. And what's happened in the course of the last 2 years is the automakers and dealers have benefited tremendously from the improvement of mix and price. So they've been able to more than offset the volume pressure. So it's been pretty impressive, and as well as very good execution. The suppliers have not benefited from any real pricing power because their end consumer is the automakers. They're not really changing pricing on a real-time basis. So they've been really getting hit in a way that the dealers and the automakers have not by just the pure volume decline. They're just eating it pretty hard on this volume decline. So I think as we look forward on a relative basis, the suppliers are likely to do a lot better if the semiconductor chip shortage issue works out and other supply chain constraints get worked out and we see a real volume lift. I think the automakers and dealers will also do fairly well, but on relative to expectations and where people are thinking about how they're thinking about these stocks and the different links in the value chain, the suppliers are the most depressed and have been hit the hardest fundamentally because they haven't had the benefit of pricing power at the consumer level.
John, at this point in time, is it more beneficial for a potential buyer, prospective buyer, to get a used car or a new car? That's all they're thinking about right now.
That we got a lot of moving parts here. When you look at this, the relative price of a 3.5-year-old vehicle, and some of these stats are coming from our great friends at Manheim and other used car sources, you basically are looking at 10 to 15 points above normal on a used vehicle price relative to a new. So normal of a 3.5-year-old vehicle would be around 50 to 55% used vehicle price to new vehicle price. Right now, it's in the high 60s, close to 70%. So relative to history, the value buy was always to go to the used vehicle. Right now, if you have a vehicle to trade in, you may actually be better off buying a new vehicle if you can actually find it, right? That's the big catch. The vehicles are really not that plentiful. So if you are lucky enough to own a used vehicle that's inflated in price, as opposed to buying another used vehicle, you're probably better off stepping into buying a new vehicle at the moment.